Welcome to Cryptonomics.
In today's episode, we will look at the 3 biggest obstacles that Bitcoin has to tackle to be truly successful.
When investing, it's always important to see the full picture. Even though we love the blockchain and cryptocurrencies, everything is not milk and honey.
So today we're going to look at what Bitcoin has going against it. Because if you're investing in something, you need to be aware of all the downsides.
If all you see is the positives in an investment and you can't see any downsides, you can bet yourself that either you haven't done enough research or you're not being objective.
And if you aren't objective, well, you're deluding yourself.
In case you want to know more about the upside of Bitcoin, check out this video over here or there, in case you're feeling blue after this video is over.
So now, let's get into the 3 biggest things that could break Bitcoin.
So, the energy consumption for Bitcoin is a very hot topic right now. And if you want to track this live, you can check out this link here.
Currently, the estimated power consumption of the Bitcoin network is 35 terawatt hours per year. This is the same amount of energy that the country of Denmark consumes every year.
If Bitcoin was a country, it would be the 57th most energy consuming country in the world. And this is growing exponentially.
And it is calculated that in July 2019, the whole Bitcoin network will consume as much energy as the whole United States. By November 2020, it will consume as much electricity as the whole world does in 1 year.
So, why is Bitcoin consuming this insane amount of energy?
Well, Bitcoin is built around the concept of enabling 2 counterparties who doesn't necessarily trust each other actually transact value. Bitcoin's creator, Satoshi Nakamoto, accomplished this feat by introducing something called proof of work.
Proof of work is a concept to validate transactions in the network. It is done through a hashing algorithm called SHA-256. This hashing algorithm takes any kind of input, like all transactions in the Bitcoin network, and produces an output with a fixed length.
The SHA-256 algorithm produces an output of exactly 256 bits, hence its name.
Generating a hash is not difficult for a modern computer. That's why the Bitcoin network ramps up the difficulty by adding certain requirements to the resulting hash.
For example, the last block to be mined while recording this video has 18 leading zeros in its hash. To find a hash with this exact number of leading zeros, you need to hash all the previous transactions plus a random input.
Finding the random input that results in the right hash is what miners are racing each other for. That means that loads of computers around the world are literally doing the exact same work over and over again, but they're trying to find new random inputs to add to the transaction.
The first one to find this random input that generates the correct hash will be rewarded in Bitcoins. And the latest transactions and the random input is added to the blockchain.
Does this sound like a waste of power? Good, because it should. That's the whole point.
Bitcoin is designed this way to give a sturdy, reliable network that cannot be tampered with. The computational power required to seize control of this Bitcoin network is enormous, and computational power isn't free. An average Joe cannot mine Bitcoin today. Just to get the hardware required to start mining takes a huge sum of money.
You also need to make sure that you're not paying more in electricity costs than what you're actually profiting from the mining, because mining takes a lot of electricity. That's why most miners are located in countries that have cheap electricity, like in China or in Iceland.
And this centralization is another problem for the Bitcoin network. With most mining done in countries with cheap electricity, we actually get more and more centralization, which is not the point of blockchain. But we digress.
I think we made clear that validating these transactions takes up a huge amount of computing power. But what about improvements to that computing power?
In the early days of Bitcoin, you could actually mine on your own laptop. Then difficulty was ramped up and people started using GPUs. Nowadays, mining operations are run with ASICs, highly specified components that are built solely for the purpose of mining.
But hardware improvement isn't keeping up to the rapid explosion in electricity usage for mining. This is a problem in itself. But a bigger question is, will better components actually lead to less energy consumption, or will it just be used for faster computation?
Unfortunately, there is no easy solution on the horizon. The difficulty of mining Bitcoin is actually increased if the network is finding blocks too often. So, if computational power increases, the difficulty will increase with it. The only real way to really reduce the power usage is if less people were mining.
Now, this doesn't mean it's impossible to find a solution. You can change algorithm to something that uses less computational power, like proof of stake, where the next block is chosen through the wealth on the blockchain, although this will give the richest holder the most power.
On the other hand, doesn't proof of work give the most power to the miners with the cheapest electricity?
We could also hope for cleaner energy sources like wind and solar, and perhaps even improvements in nuclear.
With the current trend, about 99% of all bitcoins will be mined until 2032, which means that in the future, miners will only be compensated with transaction fees.
This will likely put less of a burden on the environment, although this is 15 years away.
Speaking of transaction fees, there are two ways to get compensated for validating transactions on the blockchain.
The first is receiving Bitcoin as a price for mining.
And the second is fees.
Each transaction pays a fee to the miner. This has been implemented to incentivize miners to keep on validating transactions after the final Bitcoin has been mined.
But the transaction fee isn't fixed and you can set it to anything you want to. So what's the problem?
Well, for Bitcoin to be able to function as a decentralized system, miners need to be able to create blocks.
To not risk total centralization, where the biggest mining operations with the biggest computational power takes control of the whole system, Bitcoin has a limited size on its blocks.
But this limitation in size creates bottlenecks, especially when the user base has grown exponentially in such a short amount of time.
Simply put, there are more transactions than the network can handle.
This means there's a waiting list for transactions to be handled. And yes, you guessed it, how do the miners choose which one to validate first? It's the fees, the highest fees.
Paying a higher fee will put your transaction higher on the waiting list.
Right now, the fee can be as high as $25. Imagine paying a $25 fee when you're buying something on Amazon for $10. This doesn't really play in Bitcoin's favor as a viable currency.
Now, there are actions that has been taken to try and lighten the burden on the network. For example, SegWit2x was integrated in the Bitcoin code this summer as a way to deal with this issue.
SegWit2x changes how data is stored in the blockchain, which makes it possible to store more transactions in each block. But only around 10% of Bitcoin transactions are being made through SegWit. Why?
Well, very few of the big exchanges have actually implemented SegWit. Just a couple of days ago, GDAX, a subsidiary of Coinbase, said they will introduce SegWit2x in 2018.
Until more of the big players implement SegWit or the Bitcoin community rallies behind another solution,
like the Lightning Network, for example,
the fees will just keep going up.
And like we said earlier, transaction fees are the only way to profit from mining once all the Bitcoin has been mined. Maybe the transaction fee has to skyrocket to make it profitable to mine. But who will use Bitcoin then?
I know that this will make the libertarian in you scream with disgust, but not all regulation is bad.
Some regulation might even be good.
Really? One example where regulation is good is in the case of market manipulation.
Market manipulation is an attempt to create artificial, false, or misleading appearances on a price on a market. This is highly illegal on regulated markets. Things like pump and dumps, where a company or investor releases false information just to drive the price higher.
Illegal.
Quote stuffing, where high-frequency programs flood the market with orders just to make the competitors slower.
Illegal.
Or placing buy and sell orders from your own account just to artificially inflate the price.
Illegal.
All these illegal activities can be done on most crypto markets today, and the only one to gain from this is the perpetrator himself.
The truth is that the crypto space is like the Wild West, for better or for worse. We see an incredible innovation, but also a lot of scams. We've even seen exchanges losing a lot of money.
Take Tether, for example, which could very well turn out to be a huge disaster for the crypto space.
If you don't know what Tether is, it's a stablecoin pegged against the US dollar. What this means is that Tether follows the price of the US dollar, while also being a cryptocurrency.
Tether is supposed to be used to liquidate your cryptocurrency holdings without actually trading it for fiat currency. This could be done for tax reasons or just to avoid having to move your assets from one exchange to your bank account or vice versa.
To actually peg itself against the US dollar, the company behind Tether is supposed to always keep a dollar equivalent of each outstanding Tether as a dollar reserve. But what if there was an increase in the interest of Tether?
Well, there is. Tether's market cap increased by $300 million just last week, which means that the company behind Tether, called Tether Limited, have had to increase their reserve of US dollar by $300 million in 1 week.
So we're not saying that Tether Limited doesn't have the cash. We're saying we don't know, because Tether Limited has never been audited. And that's the point.
What we do know is that if exchanges dealing with Tether doesn't have the liquidity to handle large withdrawals of Tether, this could severely jeopardize the exchange. Exchanges like Bitfinex, which coincidentally has the same CEO as Tether Limited.
So, what happens when a company can't pay its liabilities? It goes into default. And this can pose severe problems for investors holding assets on that exchange.
Some kind of regulation and background checks on ICOs and exchanges could actually be a good thing. However, we are not sure that the national government should handle this. Maybe that's a better job for a decentralized autonomous organization, a DAO.
This is something that time will tell.
If you're feeling like selling all your Bitcoin after watching this video, make sure to watch our other video on the upside of Bitcoin.
And if you like this video, please hit the subscribe button and like this video for more.